I want to tell you about a woman. I will call Carol. She was 66 years old, a retired office manager from outside Nashville, Tennessee. She had worked the same job for 27 years. She was organized. She was careful. She kept a budget every single month and for the last decade of her career, and she stuck to it. When she retired, she had a traditional IRA with about $210,000 in it. She had no pension. Her Social Security check was $1,940 a month. She also had a small CD at her local bank, generating about $80 a month in interest, and she had $11,000 in a savings account that she called her cushion. She felt ready. 6 months into retirement, the stock market had one of its worst stretches in years. Her IRA dropped from $210,000 to about $178,000 in a matter of weeks. She watched the number on her statement and told herself what everyone says in those moments. Stay calm. It will come back. Do not panic. And then her furnace failed. The replacement estimate was $3,400. Her savings account had $11,000 in it. She could cover it. But then she thought about the car with 112,000 miles on it, the roof that the inspector had flagged 3 years ago, the prescription costs, that kept creeping up. And she realized that $11,000 was not really a cushion. It was a single bad season away from being gone. So she pulled $4,200 from the IRA to replace the furnace and build her cash back up a little. She did not panic sell. She did not make a dramatic move. She just took money from the account she always planned to use in retirement. And here is where two painful things happened at once. The first one, most people understand. She sold those IRA shares near the bottom of the market downturn during the worst weeks of the decline. When the market recovered 6 months later, those shares were worth 30% more. But Carol did not have them anymore. The second painful thing is the one almost nobody talks about. That $4,200 withdrawal became taxable income in the year she took it. And because of how the IRS calculates Social Security taxation, that withdrawal may have cost her an additional $200 to $300 in federal taxes on top of the investment loss she already took. I'm going to show you exactly how that math works, using Carol's real numbers, in a few minutes. But the point right now is this. The market drop hurt. Being forced to act during the drop hurt more, and the tax bill that followed was the part nobody warned her about at all. My name is Kevin, and this is Kevin Retirement Strategy. Every week I break down the retirement income decisions, the spending structures, the tax rules, and the financial traps that determine whether retirement actually works the way you planned it. Subscribe right now and turn on notifications so you never miss a video. Now let me tell you the real question this video is answering. Because most retirees think the question is, cash or invested? Should I keep more money in cash and feel safe, or should I stay invested and let it grow? That framing sounds reasonable, but it is actually the wrong question. The right question is this: how much cash do you need so that you are never forced into a bad financial decision during a bad market year? And here's the insight I want you to carry through this entire video. The right cash buffer is not a dollar amount. It is a gap calculation. Essential monthly spending minus guaranteed monthly income equals your monthly gap. Multiply that gap by 12 to 24 months, and that is your spending reserve target. Use 12 months. If your Social Security covers most of your essentials, use 24 months. If your portfolio must pay major living costs every month. Everything else in this video is built around that one formula. That is the framework investor.gov is pointing toward when it says that as people get closer to retirement, many shift toward less stock and more bonds and cash equivalents. It is not saying put everything in cash. It is saying the mix of assets you hold should match your time horizon and your actual spending needs. The retirees who get hurt in market downturns are rarely the ones invested too aggressively across their whole portfolio. They are often the ones who never separated near-term spending money from long-term growth money. They had a number in an account. When they needed cash, the account was the only place it existed. So they sold at whatever price the market happened to be offering that week. That is the structural problem Carol ran into, and it is entirely solvable before it happens. Let me explain the 3 categories of money every retiree needs to think about separately, because until you see them as 3 distinct buckets with 3 distinct jobs, you cannot build a cash structure that actually protects you. The first bucket is emergency cash. This covers true surprises. The furnace, the car, a medical bill insurance did not fully cover. Vanguard describes the common rule of thumb for an emergency fund as 3 to 6 months of critical living expenses. For a retiree with $2,000 a month in essential expenses, that is $6,000 to $12,000, sitting in a savings account or money market fund. not in the IRA, not in the investment portfolio, in a separate place, touched only when something genuinely unexpected happens. Carol had $11,000 that was supposed to be her cushion, but it was carrying 3 jobs at once: emergency fund, spending reserve, and backup for everything she was afraid to name. It was too small to do all 3, and she never knew it until the furnace arrived. The second bucket is the retirement spending reserve. This is the money that covers planned monthly withdrawals from the portfolio during the period when you cannot afford to sell investments at a loss. Morningstar describes the bucket approach as one where assets needed for near-term living expenses should stay in cash. Often 1 to 2 years of anticipated portfolio withdrawals in cash and another 5 to 8 years in bonds. That 1 to 2 years in cash is not your emergency fund. It is a deliberate buffer, so you never have to do what Carol did. When the market drops, you live off the cash bucket. The invested money gets the time it needs to recover. The third bucket is long-term invested money. This portion does not need to be touched for many years. It can be held in broadly diversified growth assets, because the spending needs are already covered by the other 2 buckets. Investor.gov says the right mix of stocks, bonds, and cash depends on time horizon and risk tolerance. The long-term bucket has the longest horizon, which means it can carry more growth-oriented assets, without forcing bad decisions when markets turn. 3 buckets, 3 distinct jobs. Emergency fund handles surprises. Spending reserve handles market downturns. Long-term bucket handles growth. When all 3 jobs collapse into one account, the first bad year breaks the whole structure. That is exactly what happened to Carol. Not because she made a reckless decision, because the structure gave her no other option. Now here is the decision most retirees get wrong, and this is where Carol's mistake becomes your planning tool. Carol never ran this calculation. She did not know what her monthly gap was. She just knew the IRA was there. So let me show you what she should have been asking before she retired. Because this question determines everything about how you size your cash reserve. How much of your essential monthly spending is already covered by guaranteed income. That gap is the only number that tells you whether your spending reserve needs to be closer to 1 year or closer to 2. If your Social Security and any pension cover most of your essential monthly expenses, your portfolio is only responsible for discretionary spending and occasional larger needs. A smaller cash bucket may be adequate because the portfolio is not carrying the weight of your survival, but if Social Security covers only half your essential monthly costs, and the rest must come from the portfolio every single month, a larger cash and bond cushion becomes critical. Because any month you are forced to sell investments to pay for groceries or utilities is a month where a market downturn can do permanent damage. Let me make this concrete with 2 retirees, so you can see the dollar difference. Retiree A is 68 years old. Her Social Security is $2,071 a month, which is the average retired worker benefit estimated by the Social Security Administration for January 2026. Her essential monthly expenses are $2,300. Social Security covers about 90% of that. Her portfolio only needs to cover about $230 a month in essential spending. Using the GAP formula, $230 times 12 months equals a spending reserve target of about $2,760. A relatively small dedicated cash bucket on top of her emergency fund is sufficient because the guaranteed income stream is doing most of the work. Now, retiree B is 65 years old. His Social Security is $1,800 a month. His essential monthly expenses are $3,800. Social Security covers less than half. His portfolio must generate $2,000 a month, just for essentials, every month, regardless of what the market is doing. Using the GAP formula, $2,000 times 24 months equals a spending reserve target of $48,000. Same retirement age as retiree A, same general situation, completely different cash need. Retiree A needs roughly $3,000 in a spending reserve. Retiree B needs $48,000. That gap, driven entirely by how much guaranteed income covers essential spending, is the number that determines whether a retiree survives a bad market year without touching long-term investments. Most people look at those 2 retirees and assume the difference is how much they saved. The real difference is the gap. Now I want to add the layer that makes this a Kevin retiree strategy video, because everything so far is about investment structure and spending safety, but there is an IRS dimension to this problem that most people never see until it has already cost them money. And I am going to walk through this using Carol's actual numbers, because that is where it becomes real. When Carol pulled $4,200 from her IRA near the bottom of the market downturn, that withdrawal became taxable income in the year she took it. The IRS says distributions from a traditional IRA are generally taxable in the year of distribution. Carol understood that part in a vague way. What she did not understand is what that withdrawal did to her Social Security. The IRS calculates something called combined income. It is your adjusted gross income, plus any tax-exempt interest, plus 50% of your Social Security benefits. Here is Carol's combined income picture. Before the IRA withdrawal, her annual Social Security was $23,280. 50% of that, the portion that counts toward combined income, is $11,640. Her CD interest was generating about $960 a year, so her combined income before any IRA withdrawal was approximately $12,600, well below the $25,000 threshold for single filers, where Social Security begins to become taxable. Then came the furnace year. She pulled $4,200 from the IRA. That $4,200 added directly to her adjusted gross income. Her combined income jumped from approximately $12,600 to approximately $16,800. She was still below the threshold. But here's the important lesson Carol's situation teaches. She was fortunate that one small withdrawal did not push her over. Many retirees have more other income, a small pension, some dividend income, a part-time job, interest from multiple accounts. For those retirees, a $4,200 IRA withdrawal could be the one push that crosses the threshold. For single filers, the IRS says once combined income exceeds $25,000, up to 50% of Social Security may be taxable. Once it exceeds $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. To show you exactly how the tax cost lands, imagine Carol had a small pension of $500 a month, in addition to everything else. Her combined income before the IRA withdrawal would have been approximately $18,000. After the $4,200 withdrawal, it would cross $22,200. Now add one more modest income source, say $400 a month from dividends. Her combined income after the withdrawal crosses $25,000. That is when up to 50% of her Social Security becomes taxable. At her benefit level, that could mean an additional $200 to $300 in federal taxes that year on income she was already counting on. And this is the critical point. The retiree who had a properly sized spending reserve never needed to take that $4,200 IRA withdrawal during the market downturn. No withdrawal, no combined income spike, no Social Security taxation surprise. The cash structure is not just a financial comfort choice. It is a tax management tool. There is one more downstream consequence worth knowing about. A large IRA withdrawal in 1 year can affect your Medicare Part B premium 2 years later through a system called IRMA. CMS shows that 2026 IRMA surcharges begin above $109,000 in modified adjusted gross income for individual filers and $218,000 for married couples. Most retirees watching this are well below those numbers, so a single modest IRA withdrawal is unlikely to trigger IRMA on its own. But for retirees who are already in the higher income range, any spike from a forced withdrawal could push them over a threshold and affect premiums 2 years down the road. If that situation describes you, it is worth a conversation with a tax professional before taking any large unplanned withdrawal. Now let me give you the practical framework and the 7-step checklist you can act on today. For most retirees whose portfolio must cover significant monthly expenses, the number worth building toward is 2 years of planned portfolio withdrawals in a dedicated spending reserve. That is the default starting point based on Morningstar's guidance. If your guaranteed income covers most essentials, you may need closer to 1 year. If the portfolio must fund major living costs every month, 2 years is the floor, not the ceiling. Here is the structure that supports that number. Keep 3 to 6 months of essential expenses in a dedicated emergency fund that is never counted as part of your retirement spending plan. Keep up to 2 years of planned portfolio withdrawals in cash or a money market account as your retirement spending reserve, sized based on your monthly gap. Hold the rest in a diversified mix of bonds and stocks, matched to your time horizon and risk tolerance, with enough in bonds to cover the years beyond the cash bucket before growth assets need to be touched. Now the checklist. 7 specific steps you can start on today. Step 1. Write down your essential monthly expenses, not your total spending, essentials only. Housing, utilities, food, healthcare, transportation, medications. The number your household cannot go below, regardless of what the market is doing. Step 2. Write down your guaranteed monthly income. Social Security for you and your spouse if applicable, any pension, any annuity that pays regardless of the market. Add those numbers and write down the total. Step 3. Subtract guaranteed income from essential expenses. That difference is your monthly gap. Then apply the formula. Monthly gap times 12 if Social Security covers most essentials. Monthly gap times 24, if the portfolio must cover major living costs every month. That result is your spending reserve target. Step 4. Build your emergency fund separately from your retirement spending reserve. Use Vanguard's 3 to 6 month guideline for essential expenses. Put it in a savings account or money market fund. Do not count it toward your retirement cash bucket. 2 separate pools, 2 separate jobs. Step 5. Decide whether your spending reserve should be closer to 1 year or 2 years, based on how large your monthly gap is. If your monthly gap is small, lean toward 1 year. If the portfolio must carry major living costs every month, build toward 2 years. Step 6. Keep the remaining portfolio invested in a diversified mix matched to your time horizon. Not all stocks, not all cash. A mix where the long-term portion has growth potential, while near-term spending needs are already protected in the cash and bond buckets. Step 7. Run the combined income check. Add your expected adjusted gross income in retirement, any tax-exempt interest, and half your annual Social Security benefit. If you are a single filer approaching $25,000 in combined income, you are entering the range where Social Security begins to become taxable. If you are approaching $34,000, up to 85% may be taxable. For married couples, those numbers are $32,000 and $44,000. Knowing where you stand before a crisis withdrawal happens is the difference between managing income proactively and paying a tax bill on a mistake you could not afford to avoid. Carol's story did not have to end the way it did. She was not reckless. She was not unprepared in the traditional sense. She had a retirement account, she had a savings cushion, she had a monthly budget. What she did not have was a structure that separated her emergency money, her near-term spending reserve, and her long-term invested portfolio into 3 distinct buckets with 3 distinct jobs. When everything lived in one IRA and one savings account, the first bad season collapsed all 3 functions simultaneously. She sold near the bottom, not because she panicked, but because the structure gave her no other option. The market will have bad years. That is not a prediction. That is the history of every decade of investing. The question is not whether your portfolio will face a downturn. The question is whether your cash structure lets you survive the downturn without making it permanently worse. Calculate your monthly gap. Build the 3 buckets. Size the spending reserve to match the pressure your portfolio is actually carrying. Do you have enough cash to wait? This is Kevin Retirement Strategy. If this video changed the way you are thinking about your cash structure in retirement, hit the like button right now. It helps this channel reach more retirees who need to hear this. Subscribe and turn on notifications so you never miss the next video. And drop a comment with one specific answer. Tell me your monthly gap. Tell me the difference between what your guaranteed income covers and what your essential expenses actually are. That number right there in the comments tells me exactly what video to make next. I read every single one.